Hmm. Well, folks, good afternoon. How are you? Do a quick little commentary video, let you know what I'm focusing on for this coming week. I'm waiting to hear my audio come back to me. I'm listening to headphones, so I'm not going to. Okay, I can hear myself now. Okay. All right, so welcome. Hope you're having a wonderful weekend. And we're starting off here with the indices. I'm going to run through these as a broad brush view. Then we'll do an individual daily, and then we'll drop down to a 15-minute time frame, and then I'll go into crude oil, gold, silver, and I'll look at dollar, euro dollar, and pound dollar. And that'll be it for today, okay? I'm not going to go a whole lot in terms of commentary. I'm just going to give you what I think is the likely draw, and that'll be sufficient enough. And then we'll resume on Monday once we have some price action behind us. So right away we have the daily chart, and this chart here is the NASDAQ, and I am plotting them on a line basis on the close. I'm sorry, on the high rather. Usually when you click a line chart, its default is the close setting. And what do I mean by that? Let's go over here and highlight this, go to the little thing here. This is the settings I have set, okay? So when I'm doing comparative analysis or relative strength analysis between correlated market, I'm plotting them on a line basis. And if I'm comparing their highs, I want to plot all of them on a line basis on the high, okay? If I'm looking for bullish scenarios, I would reverse this. I would plot it on the low, okay? So since they've been going up, we have everything going on over in the Middle East. I'm looking for some measure of retracement lower, and we're entering into that springtime where usually there's a tendency. It doesn't mean it's going to happen all the time. Just usually there's a tendency for the market to try to draw down a little while, and I'm looking for that scenario. We have two forms of SMT divergence. So NASDAQ, you can see I used this high here in October, the end of October, the first week of November, and you can see that they're closely associated with the same time. And NASDAQ, we just recently came up to it here on the end of January, but failed to get above this high here in the ES. So this is the S&P. It was able to go higher, and Dow obviously was able to go higher because it's unruly and it's only three individual companies that make up that index. So it's a little bit more squirrely, a little bit more exaggerated. I included here just for completeness sake. I'm really focusing on the divergence in the NASDAQ, the green, and the ES in blue. Okay, so you can clearly see that we failed to make a higher high while ES was in fact making higher highs. Then Dow was able to make another higher high here while ES was saying, I'm not interested in seeing that. And the NASDAQ was absolutely not willing to participate either. Okay, so with that said, now we can roll into a little bit more of a discussion for the other indices. So this is the daily chart for the Dow. And I like this area right in here. So springtime, first half of the year, this is where I'm expecting Dow to get to. Right there, so that's where I'm anticipating price eventually get to that by June something, mid June maybe. It can obviously do that rather quickly if things start to really accelerate in the Middle East. Run into the ES. Okay, and if you've been a student of historic price action, I'm a little bit of a buff in that regard. The S&P 500 has made a very historic level of compression. In other words, the range in which it's slowly moved into a very narrow consolidation. We haven't seen these levels in a very, very, very long time. Okay, and to a degree that it was before I was even born, back decades, the last time we saw levels this low in terms of the range it's created. So we're looking at this in regards to the continuous contract. So I think what might be beneficial is if we do a comparison of the March contract. Okay. And I like these lows right here. Now, I don't suspect that we can get there right away before the close of this March contract. So, with that said, what I like to do is when we start getting close to an expiration month, like March contract expires in a week or so, we roll over and we start trading the June contract. Okay, so the symbol for that would be M as in Michael. Okay, so I like to, about this time of the month when we have rollover, I start looking at both contracts, which is the nearby being March delivery, and then I look at the next contract, which is June, and I'm looking for disparities between what price is doing. I'm also looking for inefficiencies that may exist on the next month out, which is June contract right now, in relationship to the nearby, because the nearby is going to be the most traded, the higher interest, open interest rather, and volume. So that will build in by default more volume imbalances or common gaps in the next month out. So that next month out volume imbalance that may or may not be in price action for the March contract or the nearby, it will work towards giving me targets that would otherwise be obscure and not noticeable in the nearby contract, or in this case, March's contract. So in other words, just look at it like this. We have ES, so I have ESM for June contract 2026. Okay, and you can see how it gets real spotty over here. So it's not real helpful when we look at the next month out. So by having that also, one more time, go back to the March contract. You can see how that's nice and clean. You can see that. Now we'll also go back to do ES in the form of the continuous contract. That's this one here, okay? And you can see those exist as well. So by having that, it kind of gives us a framework for where the market may in fact draw to on a longer term macro time frame. And I say macro, don't confuse that with the 50 to 10, 20-minute delineations each hour where we're focusing on a draw to or a beginning of a move. That's not what I'm implying here. I'm talking about a overall general wide perspective because we're looking at daily charts. Okay, so I think this is where we're likely to draw to on ES for the first half of the year. We're just now getting into like the middle of March. So, and March is going to expire, and then we roll over into June contract. And the same thing, we'll look at the NASDAQ. So NASDAQ, we'll look at first the March contract. And similar lows, but I'm a little bit more excited about NASDAQ. I think they'll uh, they'll sell off more, and the reason why because comparatively in relative strength relationships, NASDAQ was the unwilling indice to go higher, whereas Dow and S&P were able to go higher when we first opened up the stream here. NASDAQ has been unwilling to go higher. So there's a whole lot of distribution. That's my assumption. That's my perspective, that I think that there's a heavy distribution going on in these stocks. So therefore, any sell-off that's seen through the broad market, that means all indices, should be seen more aggressively and travel probably more in magnitude lower in the NASDAQ stocks than that of the blue chip companies in the S&P. Not to say that they can't have it as well, and not to say that the Dow can't tumble really far too. I'm just saying that it's better, and this is why I've been telling you all I'm bearish on NASDAQ. I've been focusing on this because of these macro tenets based on the unwillingness to go higher on NASDAQ. And because we can't go higher, because we've done enough by taking out these highs here, as I mentioned, trading at the inefficiency, then giving up the ghost. All these factors, coalesce into a broader bearish market tone. And with all the things going on in the Middle East, it's just there isn't a whole lot of deep pockets of big money willing to take on risk right now. Okay, and we'll drop into the continuous contract. We'll move all that stuff. I know you're probably going, oh, look, you can go back and screenshot it, see what all that stuff was. I like these, yes, but I'm a little bit more excited about the likelihood of taking that out as well. So I like August's lows, basically, let's look at it that way, as the first half of the year draw on liquidity. If in fact we don't get there by June, I think we'll be there going into the fall months. In other words, that's where I ultimately think um, stocks are going to be heading. There's nothing bullish right now. No one wants to take on risk, and I think that we'll start seeing some events, let's say it that way, in the states that will be attributed to that, and it's going to foster fear, nervousness, skittishness on the part of the market. So all those narratives will come in play, and it'll be perfect justification for why the market's going to go down, because that's the reason why, not because there's all these factors here that we're looking at. All right, and then we'll look at NASDAQ from the perspective of the June contract. Okay, you can see how it's spotty. It doesn't help you to look at the next month out. So you have to have a common relationship between the time frame of the daily, between the nearby contract, the continuous contract, for a clear historical reference point. And then you have the wonderful aid of volume imbalances and inefficiencies that exist in this time frame while trading in nearby. In other words, whatever you can see in terms of inefficiency here or in the lower time frames, like 15-minute, 5-minute, those are going to be helpful to you because they may not exist in the March contract, because this is June. So this is thinner. There's less order flow coming in and out of this particular contract versus all of the buying and selling that's going on in the March contract, because it is the front month nearby. As we get closer to rollover date, that will diminish, and then more open interest and volume will be seen in the June contract. So there's this like little sweet spot where it affords you a little bit more visibility because of the thinner aspects of the next month that's going to become active and become the new front month. Right now, while it's next month out, all trading should be done on the March contract. But that March contract may be efficiently delivered in price, and the inefficiencies that exist on the June contract may be beneficial because those inefficiencies are to come in next month's delivery, but they may not materialize in the actual price action of March contract. So you can use the inefficiencies that form in June that may or may not be in March price action. And you'll see many times that it's drawing to those levels that are really formed on this contract month than that of the actual front month March. All right, so I'm a NASDAQ kind of guy, so we'll start here. We'll drop into a 15-minute time frame, and we'll go back to this price action here. So right away, we have sell side resting right here, and then we have sell side resting right there. So um, I'll try to be very quick about it because I don't want the videos to be all that long. And if you're watching and you can't see I guess the translation, give YouTube enough time. The last time I did a live stream, I think I went over by 2 minutes and it prevented it from happening. So I apologize. It was completely unintentional. My intention was actually to make sure that it was underneath 1 hour or 60 minutes. So that way YouTube can do whatever it does to create AI translations. All right. So, 15-minute time frame. I won't be surprised, or I wouldn't be surprised rather, if we gap lower and come up and trade a little bit into the gap and then work towards these levels in here. I'm not bullish at all. I have no reason to anticipate bullishness. By some weird event that we open a little bit higher from where we closed, I would look for an open, overlap that opening range or that opening gap, new week opening gap, overlap that, and then treat the midpoint as kind of like the resistance point of that, not try to see it go above that and go lower. I would prefer to see it gapping lower, make an attempt to try to get into that gap, preferably um, fill it before we get into tomorrow's regular trading hours and be lower. That would fit the price action. It would fit the seasonal tendency. It would fit the underlying narrative. That would be perfect. It would be everything toggling off, checking off every box that would meet the criteria for a bearish market condition where nobody's really wanting to take on risk. And because no one's willing to take on risk, that means that we're bullish dollar. Okay, so it's a risk off scenario. Basically, that's what I'm looking at. So risk off is um, the likelihood of dollar eventually moving higher, and then other foreign currencies, which we'll look at, potentially moving lower. But the indices may actually lead that. So we may see this actually start to fall off, and it kind of like bolsters the idea of a firmer dollar index, and then therefore foreign currencies would weaken as a result of that. That's kind of like what I'm looking for. I'm looking for that segue of moving into that rotation across all the markets. And obviously, at 6 o'clock today, I'll have a better feel whether or not that's on par with what we see, because whatever we open up at will give me more insight. And I'll kind of like communicate that on X once we get to 6 o'clock. Give me like the first 15 minutes of trading, and then by 6:15 today Eastern time, I'll post whatever I think is either in line with what I say here today, or if there's an adjustment I need to make in terms of my expectations. This is not meant for you to take any trades off of it. It's just I'm just sharing, you know, paper trading commentary. Let's call it that way. Okay. So you're just watching it through the tape, and we'll leave it at that. So there's a small little gap there. If we did open up firmer, it would be interesting to see it utilize that. If we open up higher than that, which again, I don't expect it to do this, but if it were, I would expect it to trade lower and then treat that as a reclaimed bearish SIBI or fair value gap, and then work towards going lower into these sell side liquidity pools. I know this looks real smooth up here, and all those ideas look, romantic, but I'm gonna side with the idea that there's so much uncertainty, so much negativity, so much risk. Okay, there's real risk involved because of everything that's going on in the Middle East and how it's spreading into other countries, and other countries are saying we're not going to back the U.S. investments anymore. We're going to probably pull our money out of that. A lot of the Middle Eastern countries are considering doing that. So that's all going to have a weight on these markets, and it's going to cause a ripple throughout all of them. And as technical analysts, okay, as a community, if we're looking at those considerations, obviously, large investment firms, um, big investors, they're going to be thinking about those things too, and they're not going to be in a hurry to get out here and assume that risk. There's nothing bullish right now, so we haven't entered a point of capitulation where one could say, well, you want to buy when there's maximum fear. Really, there isn't maximum fear yet. It's the beginning of those things coming in. So we haven't really seen a sell-off that would warrant the term capitulation, where the idea of maximum fear, then go in and start buying it. That's when smart money would do it. Right now, we're still in consolidation with the unrealized move that goes out of that consolidation lower, which makes perfect sense right now. That's the beginning stages of what I'm anticipating. Okay, so it's kind of like hopefully making that more clear. And then we'll look at ES. Same thing here. Real close proximity, sell side liquidity pool. And we'll probably have to go out to the daily to pick up the next level and range. This thing is just so consolidated on its daily. I mean, look at that. I'm gonna be honest with you. In my whole trading career, I've never seen the stock indices trade like this. Like this is you got to go way past before even Larry Williams started trading before you can see this kind of stuff. So right away, you can see these lows here and these lows here. Again, this is a March contract, so that way don't get too crazy about it. But I think that this is where we're going to draw to, and then these down here. So we have a couple hundred handles as a downside objective. If we get down to these levels, it could get real interesting. In other words, we could start seeing accelerations that go way beyond these levels here. But I'm trying to refrain from talking like that right now because I don't want to seem like I'm hyping the move up because I'm not. I've been rather consistent about my expectations. I'm looking for lower prices. That doesn't mean I can't scalp longs intraday. It just means that I prefer if I see a setup that's forming for a bearish run lower, I prefer to take that setup over something that would be maybe short-lived on the upside as a little buy opportunity. I let a lot of those things go because my focus is primarily on this context, this idea, this narrative that I think it's likely to draw lower. All right, so we basically eroded all over these wicks here on a daily. There's a small little volume imbalance there. That I think is going to be Monday, Tuesday noteworthy. So have that on your charts. They may use that to trade into it and then become inversion fair value gap. Because if you look at it, it's close here, open higher. So it's a bullish delivery of price that creates that volume imbalance. So if it trades below it, what would it be doing? It would act as the opposite. So what would be normally expected to see it trade down to it and then become a reason to go higher. If we go below it and trade back up into the lower half of it and keep the upper half clean without having any bodies laid inside of that portion of it, it would act as a means to see prices, use it as a means of allowing price to go lower. So it should be a formidable resistance if we trade down below it and come back up and keep the midpoint or consequent encroachment in control of price action. All right, so that's the skinny there. Dow, I'm not going to talk about because you know how I feel about it. I just think that it's, you know, it's a gamble. I don't like that indice, but these are the two indices I like. These are the two indices that if I have a trade idea that I like, I will put real money behind it because these markets I trust. I don't trust the Dow. The Dow can be overzealous one way or the other, and many times it can just sit sideways while the other ones, NASDAQ and ES, can move around freely. So 30 stocks are not enough for me to take the trust because it just takes one company rather to really manipulate that entire indice. Whereas in NASDAQ, it's 100 stocks, and then in the S&P, you have 500 of them. So you still see that weight of like things like Nvidia and Meta, those big stocks like that. They have a lot of tug of war effect on the indices, but not to the degree that one large company in the Dow list that makes up its indice or average. Uh, that weight is a little bit too exaggerated. And in fact, I mean, I really wish they would do away with the Dow industry average. I think it's archaic now. We don't need it. Or create another indice. Maybe fortify it with a little bit more companies, not just use just 30. Okay, everything else is updating and becoming much more efficient, and adding more companies to the stock index average for Dow, I think would be helpful. Maybe do something like 200 or 250 of them, like half the size of weighting that is used for the 500 companies that's used for ES. So we would have like NASDAQ 100 and then 250 for Dow and then 500 for ES. I think that would be a better um, measurement of market breadth across something like that than something so little in terms of weight, like 30 companies, and people look at that like it's enough. To me, it's not enough, but you teach their own. So anyway, that's what I'm looking for those averages and lower prices, those specific price levels. And then now let's take a quick look at the dollar index because it's already getting a little bit longer in the video than I wanted it to be. Okay. And over here, you'll see this high here. I think because of the war stuff that's going on, I think of the risk off scenario. If we start to see indices slide lower, that'll really add fuel to this wanting to get up into this area and take out these relative equal highs there, and then eventually challenging this high here. I think that this area here has already proven itself, but with that by that run right here and then sending it higher. So where we are at right at this moment, I would use this. Both have a suspension block at the end. I'm sorry, it has a volume imbalance, which makes it a suspension block. It's a buy side imbalance, sell side efficiency, key array, but it has a volume imbalance at the bottom where the bodies don't touch and the bodies don't touch there. You'll see a small little separation between the two. See that right there? So with that, that makes this a suspension block. And I had the wrong color, I gotta change that. So this would just simply be a classic buy side imbalance, sell side efficiency type characteristic. We would want to see it trade, if it's going to trade at all, down into this and stay out of that lower half with the bodies. So the bodies would look better not being down in the lower half of that inefficiency. So any retracement body-wise is permitted to get into the lighter area, not in the darker area. Okay, so that would be a perfect um, discount sensitivity display. Leaving a small portion down here open would be wonderful, and then send it higher. And that would put weight on euro dollar and pound dollar. All right, so that's that on the dollar index. If it were to trade, this is where I'm wrong. If we trade below this low here, everything I'm saying here goes to the wayside, and we have to wait for more information. And I would just have to consign myself to, okay, I'm wrong, and I'll have to wait for more information. But because of the war stuff, that's going to be very inspirational for a higher dollar. Now you can argue and say all kinds of things about, we're still presently under de-dollaration and it's not going to have the effect on this, that, and the other thing. Until proven otherwise, folks, I'm just going to go with the classic scenario of this is what usually happens. Okay. I can be wrong, it's okay, but these are the things I'm considering when I'm doing my own commentary, when I share my views on what I think the market's going to do. This is what I'm utilizing. As you can see, I'm not ringing in everything that's in my repertoire. I'm keeping it very, very simple. But if it takes out rather on a closing basis this low here, this one here, if it takes that out, then I'm probably wrong, and we're probably going to consolidate more. And then I don't know what we're going to do. I'm not expecting to see lower prices because we have enough in here to warrant that this low has been taken. And it's more inspiring to me to see prices going higher because of the risk off scenario. Risk off means assets like foreign currency, stock indices, stocks themselves, okay, they're likely to go lower and dollar, go higher. The one consideration that I'm having, and I think we'll hold this point until the end if I have a little bit more time left. I don't know if I'm going to have enough time because I'm going too much as it is commodities. If you look at commodities, some of like the grains, and with crude oil, which we'll look at in a moment, they're going higher. So when they go higher, it's very difficult for dollar index to go higher. So we're in that little sweet spot of what may or may not happen. We could have a short-lived period where dollar index does in fact trade with crude oil because markets aren't perfectly in sync all the time, and we're all actively all around the world globally are all weighing the effects of what's going on with Iran and Israel and the U.S. and how it's branching out in other countries. So that weight and that uncertainty is going to be perceived with different weight and significance based on who the party is looking at it. And some of these entities may view it as problematic, while others view it as wonderful criteria to trade in to help them profit from it. So you have it's a very complex thing, but I'm siding with the idea that we'll probably try to trade up above these highs and clear that eventually. Does that mean that we have to see crude oil be its own animal for a little while and just see it go higher because of the effects of the supply and demand factors that are real with the global demand for oil? Because now all the Middle Eastern countries are turning off their drill. They don't have a way of moving that oil out like when we had in the COVID stuff, where crude oil went negative $40 because we just can't turn off the drills. It takes a great deal of, well, there's a lot of things going on that have to turn those things off. They're not like our spigot or faucet in the kitchen or bathroom. We can turn the water on, turn the water off. It doesn't work that way. Okay, so they have to plan these things in advance because if they know they're not going to be able to move that much oil out, they don't want to be pumping it out. So that's what's going on right now. The countries are turning off and they're saying, okay, we're just going to stop producing and pulling the oil out. So if that happens, that's obviously going to create a shorter supply and it's going to make a greater demand. And the things that we're seeing in the dollar index may not be germane with that in and of itself. It could be just simply crude oil just goes straight up because there isn't enough supply to meet the demand. And we've already captured Venezuela's crude oil. And I've read the comments, people trying to say, well, you don't know what you're talking about because the crude oil that comes out of Middle East is much more refined. Listen, when we're talking about the global demand for it, we're not talking about, you know, highest test gasoline versus low grade 87 or 80, people need it, they're going to buy it and they're going to get it wherever you can get it. And we're not arguing semantics when it's something like this. This is a big world demand commodity. People need it, companies need it, economies need it. So what I'm saying in short is that crude oil could just simply go vertical higher and all the other factors may in and of itself be decoupled. So we can't just weight everything on the basis of there's a war, there's a shortage of supply, and the demand's going to go through the roof. So therefore, everything has to collapse because of that. Because that's not what I'm saying here, and I don't think that it at the moment is what's happening. So there's a lot of different things we can do in other markets until we see if this thing goes longer. And they're already saying it may last until September. So, which means if it's going to go to September, we're going to be doing the same stuff over there in 2027. Okay, so I'm not looking for a quick end at all this stuff. They want a bigger, broader thing over there, and I think that's what we're building a theater for that. I'm not in support of either side. I wish it wasn't going on, but it is what it is. As a trader, as a speculator, as an analyst, as an educator, talking about these things in commentary, I have to make them aware to you so that way you consider them because if you're not at least considering them, you can be broadsided by events that would otherwise not be so shocking or jarring if you aren't looking at it. Okay, because you might say, I don't trade crude oil, so this doesn't make any difference to me. Eventually, what's going on over there is going to reverberate into other markets. So let's go into crude oil real quick. We'll pull up the continuous contract. All right, and this we'll pull out a weekly chart real quick, and I'll show you historical highs. I think we're going through that. Okay, so that way this right here is going to give up the ghost. I think we'll be higher than that. Initially, I think 140, 150, and if we get above 150, it might accelerate in the 200s. We have had a run very close to this high here. That's the next one right there. We're in close proximity, so I wouldn't be surprised if we open above that or very close to it and then run to it. And then in near, we don't really have any inefficiencies. It's noteworthy until we get up into this area right in here. So that would be one that you want to have on your chart. Include the volume imbalance at the high and the low. So have that on your chart. You can see the price level axis over here, what those levels are. I'm not going to extend it over. All right, I'm going to drop down into a daily chart. And you're probably looking at the same. What is this? Can you go over that? What I'm looking at here is this sell side imbalance, buy side inefficiency. And because we opened up here, I ran that as a inversion fair value gap. So it's a SIBI. And if we open up above and we're expecting higher prices, and I told you over the summer of last year, I said, Iran is going to get attacked. I told you it was going to be an issue. I told you if you were a private mentorship student back in March 2020, I told you that watch Russia, China, and Iran. Okay. And all of my paid membership students will tell you either I'm telling you the truth or I'm lying to you. And they are welcome to come out with the commentary and post it online where I said the opposite because I said these things. So we're now seeing all those things happen. Okay. And because it's been a big buildup, I don't think this is a short lived event. I think it's going to continue. And costs for driving your car, heating your home, um, all those things are going to be much more expensive. And it's going to continuously get more expensive. So just prepare for it. But since it was a SIBI, if we're bullish and we're expecting higher prices, if it opens here, it's going to trade down into that. And if it's bullish, what do we want to see? We want to see that inefficiency not trade down to the lower half. Well, look at the bodies. The body here didn't even get down and close to, at, or below consequent encroachment, which is that green line. Okay. So let me make it a little bit broader for you. So here's that midpoint. We we went through it, but we didn't stop there. We closed in the upper half. So is that indicating bullishness? Yes. It left this portion open. It did not lay the body down on the halfway point. If it would have closed down below that, that would mean rather it's not as bullish. But because of the fundamental drivers behind this market being bullish, it's likely to see it go higher. So if it's going to go higher, we want to see it stay in the upper half. That's discount sensitivity with a BD array. It's not supply and demand. Okay. It's not market, what does it call it? The volume profile. It's not any of that stuff. Okay. It's not Elliott wave. It's not Wyckoff, none of that stuff here. So we have a range, we define it as a PD array, and bullish PD arrays are going to be utilizing the upper half. Bearish PD arrays use the lower half. So you can see the signatures here are still true even with a wartime event. The market opens up here and then rallies away. And look at this big run here using those levels that we had outlined on the higher time frame chart. That's what we're looking for. A run up into that. Is it going to be one candlestick to get up there? It could. If they drop a nuke somewhere over there in the Middle East, this is going to go a whole lot higher than I said here today. So, I'm preparing myself. I've told my students that we're eventually going to see that type of stuff, and we're already seeing the rhetoric where they're trying to put the old scare tactics. I'm a person that was born in 1972, and in school we used to have these drills at least once a week where at 1 o'clock in the afternoon, the air raid drill would sound off, this big horn would go off, and we would climb underneath our desks like that was going to protect us. And all that was conditioning and keeping us fearful. And eventually it did away. We wouldn't do them anymore. But the the language and the communication and the talking points of all the things that's going on right now, they're slowly trying to bring back in the fear of nuclear warhead, nuclear war, nuclear exchange. And I'm going to tell you this. If we did, or if you did get hit with one, you wouldn't feel anything. So don't be afraid. Okay. You probably won't even see the flash. Living in fear about that stuff is wasted energy. Okay. Sure. If you love your life and you're trying to stay here and pretend that stuff isn't going to happen in the world, it could create a fearful type of mentality for you. But to live in fear is foolish. If they drop a bomb in close proximity to you and it does those types of effects, you won't feel it. You won't even feel the burn. You'll be here 1 second and then you're not. Okay. So living in fear about it, being paralyzed by fear over that is wasted energy. So anyway, crude oil, I think we're going to go higher. I don't see any need for it to come back down and revisit any of this range. I don't think it needs to do that at all. So a balanced price range exists here. It's balanced because we've seen 2 directions. It traded up to that point and closed down, then we opened here, went a little bit lower, and then went back up. So inside of this range here, we've seen both sides of delivery, sell side and buy side. While being bullish, any retracement, if I'm wrong, it can come down to this, but it would need to stay above this box, okay? Because this is balanced. If it were to erode into that, okay, it would only have to be a spike that would use this fair value gap. I prefer it doesn't do that because I think this should act as what? A breakaway gap. So a breakaway gap, and then next fair value gap in here could be used as a measuring gap. And then half of that range, measured from the low to that, would project some measure of an upside objective. But I still think 130 is an easy objective for what we have going on right now. All right, let's go into gold. All right, so here's the daily chart on gold. I know you guys have been begging me to talk about this market. Um, Notice the difference? Why do you have settings on this chart toggled on and off in certain ones? If you look at this, all we have here is just simply a fair value gap. Low of that candlestick, high of that candlestick. Notice that I'm not annotated on that. If I take it and toggle it like this, we have a very, very nice volume imbalance that's much more uniform. Very easy. For me, let's say it this way, it jumps off the chart. And you can see how it's been utilized so far, okay? The bottom of it is used with the close on that candlestick, the open rate on the consequent encroachment, the close on this one here, the open on this candle is very, very close to it. The close on this candlestick is, I think I said that wrong. The open on this candlestick, the close on this candlestick, and the close on that candlestick is essentially utilizing that volume imbalance. So it's kind of like a knack, an experience thing. You're going to toggle back and forth, and you're going to see the volume imbalances that are much more uniform, very, very clear, obvious gaps, and how price is utilizing them. I'm going to use the setting that shows this versus that. See what happens right away? These bodies aren't really respecting anything. They're just hanging inside the range. And it doesn't line up anything over here because I'm not utilizing this. Okay, look at the bodies. See where they're at? They're outside of that fair value gap right there. This would simply be the fair value gap alone, and it doesn't do anything. You see the difference there? Big, big, big paradigm shift versus doing something like this. And then marking it from the volume imbalance, then the levels start making a whole lot more sense. And it's not random, it's not guesswork. Okay. But this would indicate there's an algorithm which we all know probably doesn't exist, right? I facetiously posted the other day that they changed the algorithm, pack it in. That was me in my typical sarcasm. I'm being funny. Yeah, I'm entertaining myself, and that they did not change anything, folks. I just do it to kind of like make fun of the people that try to make fun of me. It's a give and take, baby. So I'm sorry, gold. Where are we going? Well, it needs to use this level here. I would prefer, if it was going to go higher, I would prefer it to use this to trade higher, and then this inefficiency here from that candlestick's low and that candlestick's high. I want to see it get above that and then use that as an inversion fair value gap to try to make a run at the historic high. So this level here is immediate. What we need to see and how it utilizes this range here, firmer prices, then stay outside of the lower half. That's the minimum. If we leave this and work to the lower end, we're probably going to look for sell side below here, at least for the near term. Okay, and if it does that, then we could probably see some trouble. Okay, so right away I'm looking at this and I'm seeing like the imaginary support line that people like to draw trend lines on, and that also is problematic. So I'm very conscious of the mania, the excitement the FOMO that gold and silver has right now. And it'll probably rotate out of that into crude oil because of what's going on in crude oil. When you start seeing the moves in crude oil, everybody will start looking at crude like it's the best thing in the world and it's the only market to trade, and that is, what happens. But I think gold has the likelihood of going higher without silver going higher. And what do I mean by that? Let's look at silver real quick, and then we can run into the two foreign exchange pairs, and I'm going to wrap it up because it's getting to be a long video. So here's silver. And I talked about this in a X space on Twitter, and I kind of like went over the idea of instructing you, talking about looking at the 1980s event where the silver market was being cornered by a couple brothers. And I'll let you research all that stuff. I don't want to steal the thunder from reading. It's a very entertaining event to study and read about. But the exchanges changed all the rules in exchange for extremes to kind of like prevent the market to go any higher. And there's a lot of speculation about a particular bank, and maybe even more than one bank, that has been short the whole time here with this run up on silver. And they had to be bailed out by the Fed because they couldn't meet their margin call. Okay. So a large institutional bank being short on silver and had to get bailed out by the Fed overnight, and they didn't answer their margin call. So I, I'll just say it this way, okay? I am under the assumption that what they may do is let silver collapse back down into the low 50s, maybe even back down to 48 by the time March contract expires. I know that sounds extreme. I would not be surprised. It probably won't happen, folks. I'm not saying get short silver. I'm not trading it. God's honest truth, my hand to God. I'd have had Bibles stacked in front of me right now, live streaming it. You can see me. I'm not trading silver. I'm not trying to trade this market because it's highly, highly, highly manipulated right now. Fun going up. We called it going up. But now, with this rate in here, that tells you no, there's not enough silver. If everybody wanted the delivery, the actual delivery of all the contracts that are available for purchase that are being holding long, they don't have enough silver to meet that demand. So I talked about a scenario where they would go into the cash market and they would start offering lower prices on cash exchange because they can't fulfill the delivery of the silver. So you're not going to go out there and find this anywhere. Like it's not widely publicized, but that's exactly what happens. It's happening for in other markets. But if you're not a commercial consumer or user of a commodity, you would never know about that. But here, because there's this big rush to get into physical ownership of silver because its fundamental resource is in demand because of a lot of things right now. For instance, the cell phone, the battery problems that we've had, and Samsung has a real huge interest in acquiring more of it because that little piece of silver can prevent the battery heating up and catching on fire. So by having that little piece of silver in there, it mitigates that problem. But that little piece of silver across millions and millions and millions of cell phones is big money. And they need to have a stock of it on hand all the time because there's always, planned obsolescence in our cell phones, which should be against the law, but they allow it. Um, by the way, remember when they were saying they're going to take all that bad stuff out of the foods? And I'll leave it to them. They can decide if they're going to take it out or not. What did you vote for, by the way? Oh, I'm not supposed to be talking about that stuff. Sorry, 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 sorry. I can't edit it out because it's a live stream. So it's there. So that's a talking point for all you guys later on today. Silver, I think it's more likely that they'll drop it lower to allow the boys in the club to get out of their margin issue, their margin call issue, um, and then we'll see another event what we saw in the 80s where you'll see it's rigged. You'll see it's rigged, and that was a testimony back then before electronic trading how they did it. Now they can do it differently because it's electronic trading. They can do a whole lot of different things. So I would be concerned trading silver either way. But if I were a gambling man, based on just this speculation on that there may be a bank or two that and the exchange, has its reasons for doing it too. I think there's a whole lot of tomfoolery expected the rest of this month, and I'll leave it at that. If I'm wrong, okay, it's wrong. I'm not going to make your money. I'm not going to lose any money on this. I'm just sharing my opinion as to why I would not touch it. Now, if you have a system and you trust your analysis and you think it's going to go straight to the moon, and you want to fade me and you want to come back on Twitter or make videos about this is what ICT said here and this is what I did. I made so much money. Before you do that or you have that idea, go out and tell everybody what you're doing and share your positions right now. And then you can come back and get your clout that way. Don't do it in secret where you have the benefit of anonymity. And if you lost, you won't be able to be judged on that. So unless you come out and say, this is what I'm doing, this is what I'm holding, anything you say past this point, it's going to be silly. I'm just telling you, the maturity in me as someone that's been doing this for a very long time, watching markets for a very long time, trading markets for a very long time, I'm telling you, I wouldn't touch this one. I wouldn't touch it. There's more vested interest in this market screwing everybody that wants to see it go higher and protect the good old boy club by just simply saying no and then reprice it lower. And you'll see, buying and selling pressure do its thing, right? So that's that. And let me get over to euro dollar. All right, I always use forex.com, not because I trade with them. I don't have any forex accounts right now. I haven't traded forex in a long time. It's been years. But forex.com, that's the data I use, I draw from. And I shared this chart the other day on X, and it's in sync with what I was saying about the dollar index. Um, Risk off scenario, with the exception of gold and crude oil, because they are safe haven markets. They'll go there in extreme conditions like we have right now. We have potentially. I'll just say it. We're in World War III. Okay, everybody else doesn't want to say it, and I've been saying it for months now that we're already in this. Just like if you study world history, real world history, and it's real hard to get a good historical book anymore because they're changing everything. It was a very long time into World War I and World War II before they actually said it's a world war. But that's what we're seeing right now. So we are in World War III. The idea of gold and crude oil going up and having dollar index still see higher prices still can happen because there's fundamental drivers driving those other markets. Okay, it doesn't matter what the dollar index is doing. If they're doing what they're doing over there in the Middle East, it's going to affect the price of crude oil. And if the demand is like it is globally, what's going to happen? Supply is going to diminish, demand's going to extrapolate, and prices are going to go up. So here's the opposite of that here, where if the dollar index is going higher because of the uncertainty, this would likely draw down and take out sell side. And I would want to see none of this range here be utilized at all. In a perfect world, this would stay untouched. That area right there. We want to see that completely kept virgin terrain. Nothing utilized there. It can use this portion down here. So that would look like this. It can use this little portion of price action, and that would be okay. Like trading up into that and then rotating down here. That's permissible to me. I would expect something like that. That would be reasonable. Um, Also, if you see this little fair value gap here, go on the other side of the curve. This is the sell side of the curve here. Towards this candlestick to the left this is the buy side of the curve. So then you can use this as well. You have this candlestick's high, that candlestick's low, drag that on over, and you have a coupling of a normal premium array, and then you have a old level that would have otherwise been bullish if this market was higher or prone to go higher. It would use this, then went higher. But because it gave up the ghost here, we took out that sell side there, and we have relative equal lows there. It can utilize this, and it could perform as an inversion fair value gap. So we have two PD arrays stacked and nested over top of one another. That was the reason why you're probably asking me. You're saying, well, tell me why you wouldn't want to use that. I just did. So here's the reason. So you have a potential inversion fair value gap, and then you have the standard fair value gap here, there. So they're nested right there. So whenever there's a nesting area of two PD arrays agreeing with the context, anything higher than that, like we have here, I want to see that stay open. Now, can it wick through this and tap the low of that, or maybe in the lower quadrant, some wild price action, and then give up the rest of it in the range, be back below here? Sure, it can do that. Why? Because of the volatility we are experiencing in the marketplace today. So all these factors have to be considered when you're utilizing trade ideas with stop loss placement, which is exactly why I've been telling you for over a year now, use the smallest leverage. Don't try to get rich right now because you see all these markets doing crazy stuff. These crazy stuff type like moves that we're seeing could wipe you completely out. And it's not fun to come out of those types of things, especially if you're trading with real money and cash accounts. How easy is it for you to refund yourself right now? Everything being expensive, right? So you want to try to be very mindful of that. Go build your wealth slowly. You won't have the problems that everybody else has trying to get these big fash, lottery wins. All right, so lower prices, that's what I'm expecting. I'm expecting these key prices here, and then we'll go into the last one here. Let me make sure I'm saying that right. We went through crude oil, we did dollar index, gold, silver, indices. Yeah, this is the last one I'm going to look at. So now I'll look at Bitcoin. Some of you are like, oh, talk about Bitcoin. He read my mind. Chapstick. Okay, so here's pound dollar. Why am I saying chapstick? What do you say that for? I saw you type that in a response on X. What is that about? It's from a movie, Mothman Prophecies, with Richard Gere, and when he's dealing with Indrid Cold, he's able to tell Richard Gere's character things that he wouldn't otherwise know. And when he got it, a question presented to him says, what am I holding, or what's in my shoe, and all those types of stuff. He is chapstick, and it freaks Richard Gere out. And when I do things and it seems like we're in sync and I'm reading your mind, I use that little hashtag chapstick to kind of like take you back to that movie scene. One of my favorite movies. Wonderful psychological thriller. But here's pound dollar, and we have relative equal lows down here. So again, if we expect firmer dollar, I would expect eventually seeing, because the exaggerated characteristics that pound dollar is versus euro dollar, I would like to see it use this draw on liquidity. We've already traded down into this inefficiency, and I would like to see this, all things being equal. In other words, if we see higher prices on dollar, I would like to see this, which is acted as short-term discount sensitivity. I want to see this erode and go through it, and then use this as an inversion fair value gap to eventually propel prices lower. What changes my mind about this? Well, let me go back to euro dollar for a second. That level here, if we get above halfway point here, consequent encroachment, I'm absolutely wrong. I'm absolutely 100% wrong. Until it does that on a closing basis, this is what I'm expecting, and then lower to down to this low here. Okay, so this is the near-term draw, and then there. Okay, so that fair, and then euro dollar. I'm sorry, pound dollar. We're expecting relative equal lows here, and where I'm wrong here is it would have to go above consequent encroachment of this wick, and I'll tell you why in a second. Give me a second to annotate it. And I'm just going to show, show me the midpoints. I have this in here to toggle negative and positive back and forth. That's the reason why it looks like that. I'm only going to show the midpoint level. So consequent encroachment, I don't need the high and the low. Okay, so this wick, okay, excuse me, we have a short-term high. It used that run off there. There's a small little gap there, okay? It could utilize this week and then still roll over. That's permissible. I'd prefer it left it open, use it as a breakaway gap, but it's still okay if it touches it and trades inside here. This wick, okay, while we're here, look up through this price level or price run. This gap we just talked about, I want to see it treated as a breakaway gap. This wick, okay, it's a discount wick in its formation, but it's above where we're at in market price. That means this is going to have a premium sensitivity. All this range in here, all this stuff here, I'm looking at none of the candlesticks. I'm not looking at the order block. I'm looking at that wick because it takes precedence. Why? Because it's a balanced price range. It has done two things. It's traded down and right back up. So it's did two deliveries of sell side delivery and buy side delivery, not liquidity. It means delivery and price action going higher and lower. Since it's done that, you can see it utilize that same aspect here by going up and creating that high. So in essence, I don't need to use this high because it's already used this framework here. So if I know that I'm expected to be bearish, I will allow for price to get up to this level and touch it. Preferably, it doesn't. But unless it closes above here, I'm bearish on pound dollar. Okay. And I think that's going to be it. I've enjoyed hanging out with you guys. I think I may have done it inside of an hour. And talk to you till I talk to you next time. Be safe.